Hello Kanna, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video, we are going to quickly revise the salary head of income for CA Intermediate Direct Tax paper for May 26, September 26 and Jan 27 examinations. But before beginning, as usual, my humble request to you is to please like this video Kanna, leave some good comments in the comment section, subscribe the channel so you never miss an update, and also if at all you find a button called hype button below this video, make sure to click and give me some points so that this video reaches a newer audience as well. Now without further ado, let us begin the revision. Salary head of income. Firstly, let us discuss what is the concept of salary as per the Income Tax Act. In Income Tax Act, not only the regular monthly amount which is received by the employee is taxable, other than that also, if any amount is arising due to an employer-employee relationship, that amount is taxable under salary head of income. To understand what is employer-employee relationship, you should know what is the difference between contract of service and contract for service. Because if there is a contract of service, it gives rise to employer-employee relationship and hence it is taxable under salary. But if there is contract for service, then it is taxable under profit and gains of business or profession. For example, if there is Laika production is going to Rajnikant and offering Rajnikant a movie that he should act in this movie, and that is the contract. They are going to pay him 100 crores for this movie. This case is called contract for service, and in hands of Rajni it is going to be taxable under PGBP head of income. However, if Laika production go to Rajnikant and tell him that we are going to pay you 100 crores and you have to be our employee for 1 year, and this in 1 year we can ask you to act in movie also, we can ask you to act in serial also, we can ask you to do advertisement also. Whatever we say about acting, you have to do everything. So that is called contract of service, hence it is taxable under salary head of income. You got the difference? Next, let us discuss a few intricate points. Firstly, salary to partner is not salary Kanna, because partner is not an employee of a partnership firm. Partner is a part owner of the partnership firm. That is why when partner is receiving salary, it is always taxable under PGBP head of income, never under salary head. Then member of parliament and member of legislative assembly. So when they are receiving salary, the member of parliament and legislative assembly are not the employee of the government Kanna. They are only the people who are forming the government. That is why when they are receiving the salary, it is taxable under income from other sources head of income. Fine. Next, sir, whether full-time salary is only taxable under salary head or part-time also taxable? Answer is both full-time as well as part-time is taxable under salary head of income. There should be employer-employee relationship. Only that is the core principle. Then salary forgone is also taxable. For example, if the employee is asking the employer to donate his salary to charity, in such case that donated amount also will be taxable in the hands of the employee because it is salary forgone. However, in some cases where central government is asking central government employee to forgo the salary, then it will not be taxable. Then, can there be tax-free salary? Answer is yes, because the employer pays the tax in behalf of the employee, that is tax-free salary. But however, when employer is paying tax on behalf of the employee, then this is also a benefit given by the employer. That is why the tax paid by the employer on behalf of the employee is also taxable under salary head of income. But what if there is a tax on this tax also? Then tax on tax will not be taxable, because we will learn the tax paid on non-monetary perquisites is exempt from tax. So tax paid on non-monetary perquisites is exempt. Similarly, in the hands of the employer also, when employer is paying the tax on non-monetary perquisites, that is not allowed for them as deduction. Okay. Next, place of accrual. So wherever the salary is received, no, in that country it will be taxable. So if salary first time it is received in India it will be taxable. Moreover, if the employee is working in India, then also it will be taxable in India. This we have learnt in residential status chapter. Now let us come to charging section, because every head of income will have a charging section and a computation section. In salary, the charging section is section 15. What does it say? Salary is chargeable to tax on due or receipt, whichever is earlier. So if it will be due, then it will be taxed on due itself. However, if the salary is received in advance, then in advance itself it will be taxable. So due or receipt, whichever is earlier. So where salary is paid in advance, it was taxed in the year of payment, then it cannot be taxed once again when it becomes due. So if an amount is already taxed, it cannot be taxed once again Kanna. Similarly, where arrears of salary were taxed in the year it was due, it cannot be taxed once again in the year in which it is actually received. Then now let's talk about computation of salary. So section 17 is the computation section, but before that let us learn, section 17 is the computation section. Let us learn what and all is included in salary head of income. In salary head of income there is no specific format. You should just know what is taxable under salary, what is not taxable under salary. So whatever is taxable you add it, whatever is not taxable you ignore it, then you will get the total salary income. From that you reduce the section 16 deductions, and finally you will get the income from salary head. Okay, well, it is very simple. There is no specific format for salary. Sir, if I am having basic salary, should I write that basic salary first, then I should write DA, then I should write allowance, like that in order I should write? Answer is no. There is no specific order. So if you want, you can write gratuity first, bonus next, basic salary you can write in the last also. That is not a problem. Fine. Now let us talk about what and all is taxable under salary head of income. This we will learn in 3 subsection. Section 17 subsection 1, 17 subsection 2 and 17 subsection 3. 17 subsection 1 speaks about salary. So whatever is included in salary, what and all are included? Allowance is included in salary, wages is included in salary, annuity means monthly or quarterly, whatever amount is received, that is included in salary, pension is included, gratuity is included, fees, commission, advance salary, leave encashment. So all this is included in salary. Moreover, if there is any employer contribution to this retirement funds, that is also included in salary. Now let's talk about section 17 clause 2, which talks about perquisite. To know what is perquisite, it is better if you know what is the difference between allowance and perquisite. See, allowance is already included in the salary. Okay, but perquisite is mentioned separately in section 17 subsection 2. Now what is the difference? Allowance is always a fixed amount that is received. So it is a fixed amount, it does not change. However, perquisite can change based on the benefit or facility. Okay, so perquisite can be given in money form also, perquisite can be given in kind form also. So both forms it can be given, but allowance will always be in money form. Then whether incurred or not, allowance will not change. So for example, if I am getting some allowance, it is not necessary that I should spend that allowance. But if it is perquisite, then it is considered as perquisite only when it is spent. Let us see one small example to know it better. For example, the employee is there. From the employer he is getting facility of cab. That facility of cab can be in 3 ways. First, he is getting 2000 rupees per month for cab expenses. Now this 2000 rupee per month is a fixed amount which is given for cab expense. It does not matter what is the actual amount spent by this employee. In this case, hence this 2000 per month will be called as allowance. Okay, because it is a fixed amount. Then let's talk about next example, that is cab facility. So employer himself is giving the cab facility to the employee. In this case, it is in kind, hence it will be called as perks. Okay, and then lastly, reimbursement of cab expense. So whatever expense is incurred by the employee, that employee is giving the bills to the employer and employer is reimbursing it to the employee. In this case, the expense depends on the amount which is incurred by the employee. That is why even this will be called as perks, perquisites or perks. Fine. So this is the difference between allowance and perks. Now let us talk about section 17 subsection 3, which is profit in lieu of salary. In capital receipt versus revenue receipt, in basic concept chapter, I would have told you that capital receipt is taxable only if it is mentioned in the Income Tax Act. That is why 5 capital receipts are mentioned in the salary head of income, so that it will be taxable under salary head of income. So what are these 5 capital receipts? Number 1, compensation on termination of employment. So if employee is asked to leave the organization, if he is getting some money for that, that is called compensation on termination. Then compensation on modification in terms of employment. So if employment terms are modified, okay, from one role he shifted to another role, for that he is getting some extra amount. This is called compensation on modification in terms of employment. Then payment from Provident fund or any other fund. So whatever retirement benefit is received, Provident fund, gratuity, pension fund, all these are also taxable under salary head of income. Then key man insurance policy. Key man insurance policy amount, if it is received by the employee, it is taxable under salary head of income. If it is received by the employer, it is taxable under PGBP head of income. If it is received by any other person other than employee or employer, it will be taxable under income from other sources. Okay, then lastly, lump sum or any other amount before joining the employment or after cessation of employment. So for example, before joining, the employee has received some joining bonus. So this joining bonus is also taxable under salary head of income. Fine. So these are all the capital receipts. Now you know what and all is taxable. Now let us learn some small points before beginning the chapter, so you are clear with all those terms. Fine. Terminology, let us clear. First and foremost, let us discuss what is pay scale, because sometimes in question they give pay scale and students are unable to answer. So for example, in question if you find something like this, Vanya joined Best Academy on 1/7/2023 on a pay scale of 10,000, 1,000, 13,000, 1,500, 16,000, 2,000, 20,000. So this means what? This means that the monthly salary is going to be 10,000 rupees, and after 1 year it is going to be increased by 1,000 rupees. So next year it will become 11,000 rupees. Then after 1 year it will become 12,000 rupees. After 1 year it will become 13,000 rupees. So till it reaches 13,000, it will be increasing by 1,000 every year. After it reaches 13,000, it will be increasing by 1,500 every year. So 1,000, so it will become 14,500 till it reaches 16,000. After it reaches 16,000, the salary will increase by 2,000 rupees every year till it reaches 20,000 and so on. So like this, you have to read what is the pay scale. Now in this example, if you calculate for 25-26, your amount of salary will come as 1,41,000. If you yourself want to calculate, you can pause the video, calculate so that your concept is clear, and then move on to the next part. Now let us talk about specified employee. Specified employee, no, from exam point of view, this time it is very important. Generally it is not tested. However, this time there is an amendment. You can see in green color, no, there is an amendment in this part. That is why it is examination point of view, it is very important. So let us discuss who is specified employee and why we are learning about specified employee. So specified employee means big employee. Like this you can remember. Specified means big employee. Specified employee means big employee. So who are all these big employees? Let us see. Number one, if an employee is a director of the company, that employee is a specified employee or big employee. Then if an employee is having substantial interest in the company or partnership firm or whatever the concern may be, substantial interest. Substantial interest means what? Either 20% or more voting power or 20% or more profit share. So if a person is having substantial interest, that person also will be called as specified employee if the person is working in the organization. And thirdly, if the salary is more than 4 lakh rupees. If the salary is more than 4 lakh rupees, and this 4 lakh rupees no kanna, you have to do after the calculation of taxable salary minus non-monetary perquisites minus deductions. So deductions also include standard deduction, correct? So first you have to take the entire taxable salary. From this, what are all the non-monetary perks you have to reduce. From that you also have to reduce the deductions. So after reducing this both, if your amount is coming up to 4 lakh rupees, then not specified. But if it is greater than 4 lakh rupees, then the employee is a big employee or a specified employee. So who is a specified employee? Number one, director. Number two, a person who is having substantial interest. And number three, whose net salary is more than 4 lakh rupees. Now what is net salary? Net salary means taxable salary minus non-monetary perquisites minus deductions. So now why we are learning this specified employee kanna? Because for specified employees only 5 types of perquisites are going to be taxable. For non-specified employees, which means small employees, it is going to be fully exempt. Okay, there is no rules, no condition, no limit, nothing. These 5 perquisites which I am going to tell you now are going to be fully exempt for non-specified employees, means small employees. It is fully exempt. What are the perquisites? Number one, provision of sweeper, gardener, watchman or personal attendant. So some domestic servant has been given to the employee. In such case, it is fully exempt in the case of non-specified employees. Then facility of gas, electricity, water supplied by employer. So employer is only paying the gas, electricity, water bill. In such case, it is fully exempt for non-specified but taxable for specified employees. Then free or concessional tickets. So travel tickets, if it is given to the non-specified employees like railway employees, okay, bus employees, airline employees or any other employee, if they are getting free or concessional tickets, travel tickets, then it is fully exempt. Then use of motor car. So if the employer is providing motor car facility, that is also fully exempt for non-specified but taxable for specified. Then lastly, free or concessional educational facility. So educational facility also fully exempt for non-specified employee, but it might be taxable for specified. For specified also there are some limits up to which it is not taxable. That and all we are going to study. But however, for non-specified, it is fully exempt. However, you should know one point, that obligation of the employee met by the employer is not exempt Kana. The facility directly if it is given, then only it is exempt, but obligation is not exempt. Sir, can you give me an example? Yes Kana, definitely. So let's say there is a sweeper facility is given to the employee. Sweeper means what? Who will sweep the floor. So sweeper facility is given to the employee. Now this employee, the sweeper is there, no? The sweeper is hired by the employer only. Employer is only paying the salary of the employee. Hence it is called sweeper facility. In the hands of non-specified employee, it is completely exempt from tax. But now let us talk about another situation where sweeper is actually employed by the employee himself, but employer is just reimbursing the salary of the sweeper. This type of case is called obligation of the employee met by the employer. Sir, how can I know whether it is obligation of the employee met by employer? You should only ask one question, very simple question. What is that? If employer didn't reimburse, still will the employee have to pay or not? If the employer did not reimburse, still will the employee have to pay that salary? If the answer is yes, then it is an obligation of the employee met by the employer. It is not exempt for specified also, non-specified also. Okay, well, however, if directly the facility is given. Now in the first example that I told you, what will happen? Let's say the employer did not pay the salary. In such case, should the employee have to pay? Answer is no. Employee also need not pay because the sweeper was hired by the employer only. So in this case, sweeper facility is exempt in the case of non-specified employees but taxable in the case of specified. But if it is obligation, it is taxable for specified also, non-specified also. There is no such difference. So I'll give you one more example. Let's say gas, electricity, water bill. So gas, electricity, water bill, if it is directly paid by the employer, then it is a facility. Then employee in the hands of non-specified employee, it will be exempt. However, if gas, electricity, water bill is paid by the employee, however, employer is just reimbursing the amount, then it is not facility, then it is just obligation of the employee met by employer. So how will you know that it is obligation? Because you should answer one question. The question is that if the employer is not paying the gas bill, should the employee have to pay or not pay? If the employee has to pay, if employer is not paying, if the employee has to pay, then it is an obligation. If the employee need not pay, then it is not an obligation. You get my point? I hope you are clear. If you are not clear, no still, then you rewind in the last 20-30 seconds, watch this concept once again till you have clarity, till you understand my example. Then we will move to the next part. Okay, well? Now let us see what are all the salary definitions which is going to come in your salary chapter. So there are 5 types of definition Karna. I have named it as salary 1, salary 2, salary 3, salary 4 and salary 5. So salary 1 is basic salary. It is only going to come in entertainment allowance deduction. Then basic plus DA. This salary definition is only going to come in gratuity PGA calculation. But then this salary definition, third one is very important. Basic plus DA term plus commission turnover. Okay, or turnover commission. This salary definition is going to come in many places. So gratuity, non-PGA, leave encashment, voluntary retirement scheme, retrenchment compensation, house rent allowance and recognized provident fund. So all these places, the same salary definition is going to be tested again and again. And then lastly, there is salary number 4, which is a big salary definition. It is going to be tested in rent-free accommodation and hotel facility. You have to by heart. And lastly, salary plus DA terms. This one definition is there, no? It will not come under salary head of income, but it will come in PGBP and deduction head of income Karna. So PGBP head of income also about when it is about contribution of employer to pension fund. There it will be tested. Similarly in deduction also, contribution to pension fund, this salary definition is going to be tested. So now itself you be thorough and you know the difference between all the salary definitions so that you don't get confused in the examination. Clear? Now in the different places, somewhere we will find number of years of service rounded off or number of years of service completed. So if it is number of years of service rounded off, then you have to do the rounding Karna. So if it is 6 months, up to 6 months, it will be taken as 0. Here you have to be very careful that 10 years 6 months, if it is exact 6 months, generally what do? We do upper rounding. But if it is exact 6 months, you have to do lower rounding in case of number of years. So 10 years 6 months will be considered as 10 years only. But even if it is 1 day extra, 10 year 11 months, it will be considered as 11 years. So you have to do rounding off. Wherever we find number of years of service rounded off. Okay, we will find in two places, that is gratuity PGA calculation, retrenchment compensation calculation. Then you will find in three places, you will find number of years of services completed. Completed means what? Only completed years of service you have to take. So if 10 years 11 months is completed, then how many years are complete? Only 10 years is complete. That is why you take only 10 years of service. Okay, it is used in gratuity non-PGA calculation, leave encashment, and also in voluntary retirement scheme. Then in some places the question will ask you to find, or you are required to find, the average salary. So average salary also, different places the method to calculate average is different. When it comes to gratuity non-PGA calculation, it is 10 months before the month of retirement, but in case of leave encashment, it is 10 months before the date of retirement. So this also you have to be careful. And retrenchment compensation totally different. It is, if at all the employee is receiving monthly salary, then it is 3 months before the month of retirement. If the employee is receiving weekly salary, then it is 4 weeks before the week of retirement. And if the employee is receiving daily salary, then it is 12 weeks before the date of retirement. 12 weeks before the date of retirement. This is not that important. If you remember, well and good. If you don't remember also, don't worry. It might, most probably will not be tested in the examination. So gratuity, leave encashment, and retrenchment compensation. So different average definitions, salary definition, and years definition I have given you in the same page, so that it is easier for you to memorize. Now let us come to the actual salary terminology. What and all is going to be taxable, and what is their meaning? Let us see. Firstly, basic salary. Basic salary is only the regular monthly salary which is received by the employee. It is taxable under salary head of income. Next, if any fees is also received by the employer due to employer-employee relationship, then such fees also will be taxable under salary head of income. Then commission. In commission Nokana, we should know the difference between turnover and commission and other than turnover commission. Turnover commission means what? Commission which is given as a percentage of turnover achieved by the employee. For example, the employee is a sales employee. The sales employee, they will generally get fixed pay plus variable pay. So fixed amount will be a monthly amount. Variable amount will be based on the sales achieved by the employee. So if as an employee, if I am able to achieve 1 crore sale, sometimes the employer will give me 1%, that is 1 lakh rupees I will get. So this 1 lakh rupees, which is 1 crore into 1%, will be my turnover commission. So in certain definitions, turnover commission is given separately. So you should know what is the difference between turnover and other commission. So turnover commission means what? Commission as a percentage of turnover achieved by the employee. Now let's come to bonus. Bonus means what? Lump sum amount given to the employee. It can be fixed bonus also, it can be variable bonus also. However, bonus is there, it is always taxable on receipt basis. So whenever bonus is received, then only it is taxable. Now let's talk about advance salary. Advance salary is the salary which is received in advance. So before itself the employer is paying, it is advance salary. If the advance salary is already taxed, then once again when it is due, it will not be taxed once again. Okay, then advance salary, it is taxable as salary. However, you should not get confused between advance salary and advance against salary kana, because advance salary is salary received in advance, but advance against salary is a loan given by the employer against the salary. So it is a loan. It means what? The employer is giving a loan to the employee. If at all employee is not able to repay the loan, then it will be deducted from the salary. That is only advance against salary. If at all you find advance against salary, then perquisite also might be there in the question. So you have to calculate the interest perquisite also. Fine. If the loan is given for concessional interest or low interest or no interest, then you have to calculate what is the interest perquisite. That also we are going to discuss in this video only. So don't worry. Watch this video till the very end. Okay. So arrears of salary. What is arrear of salary? Arrears of salary means past year's disputed salaries is received in the current year. That is only arrear of salary. If it was already taxed when it was due, then no need to tax when it is received. However, if it was not taxed earlier, then in the year of receipt, the arrear salary is going to be taxed. And when it comes to arrears, you should also get 89 relief. 89 relief. That also we will discuss at the end of the video. So now all the basic terms we know. Now let us jump to allowances. So let us first discuss fully taxable allowances. Now, fully taxable allowances are there, no? So many are there in your study material, but I am not going to discuss all of them. You know why? Because if you know what is exempt, that is enough. All the other allowances are, however, going to be taxable. So you just learn what is exempt, that is enough. Other allowances, if you see in the question, it means they are going to be taxable allowances. Fine. So I am not going to discuss them separately. So some burden I want to relieve from your shoulders. Okay, wow. Dearness allowance. Sir, however, the students are not studying this salary chapter properly. So let me make some effort from my end to do all this consolidation in the chapter, so that at least you will put some effort. Now that I have put some effort, you also put some effort, balance effort, so that you are remembering the salary provisions and not making a mistake and scoring marks in the examination. The salary chapter is a scoring chapter. It is not concept based. It is fully memory based only. So if you remember the provision, you will easily be able to attend and score full marks in the examination. And you know what? Other people skip this chapter and go. So if you are not skipping the chapter, you are learning this chapter thoroughly, you will have an edge over the other students, and definitely you will be able to score exemption in the income tax paper. Okay, coming back to revision. Fully taxable allowances. First allowance that I want to discuss is dearness allowance. So dearness allowance, if you find in the examination, it is always fully taxable. There is no exemption, no nothing for dearness allowance. Okay, but why are we learning separately? Because in dearness allowance there can be two types of DA kanna, that is dearness allowance in terms and dearness allowance not in terms. If it is dearness allowance in terms, it means what? While the terms of the salary were decided, that time itself dearness allowance was decided. Hence, dearness allowance in terms generally forms part of retirement benefits. But if dearness allowance are not in terms, it generally does not form part of retirement benefits. So in question, they can give you DA terms also. Or DA in terms, they can write it and give you also, or they can also tell that this dearness allowance form parts of retirement benefit. So with the wordings itself, you should be able to identify whether it is DA terms or DA not in terms, and you have to apply to the salary definition accordingly. Sir, what if it is not given in the question, whether it is DA terms or not in terms? So if it is not given in the question, then you have to assume. What to assume, sir? You can assume both kanna. Both are good assumption only. You can assume in terms also, you can assume not in terms also. But for simplicity's sake, let me just tell you, you just assume in terms and solve the question. Okay, wow. So this is dearness allowance discussion. Then what about all the other allowances? Whatever exempt allowance that I mentioned, other than those exempt allowances, all the other allowances are going to be taxable allowance. Okay, well, now let us discuss exempt allowances. So firstly, any allowance paid to a judge of a high court or a supreme court as per the respective act is going to be exempt. But this high court, supreme court judge and all no kanna, for this the allowances are exempt only in the old tax regime. They are not exempt in the new tax regime. Fine. So this you have to be careful. When the judge is receiving the allowances, they are exempt in the old tax regime, not in the new tax regime. So allowance received by United Nations organization. So salary and allowance both received by a salaried employee of United Nations organization is fully exempt in the old tax regime, but not exempt in the new tax regime. Then sumptuary allowance received to a judge of a high court or supreme court, that is also exempt in the old tax regime, not exempt in the default tax regime. Then section 10 clause 7, if there is any allowance and even perquisite paid by an Indian government to an Indian citizen outside India, it is fully exempt. And this exemption is there under both tax regime, under default also, optional also. Now let's talk about house rent allowance. Section 10 clause 13a HRA. So HRA allowance is given by the employer to meet the rental expenditure of the employee. Okay, well, now there is an exemption under section 10 clause 13a for the house rent allowance, but this exemption is only available in the old tax regime, exemption not available in the default tax regime. So not allowed under section 115 BAC. What is the exemption, sir? To calculate the exemption, you have to first step you have to take what is the HRA actually received. HRA actually received. Sir, but for what period I will take this house rent allowance? The period should be the relevant period. Relevant period means period during which the accommodation was occupied by the assessee. So during the period during which the assessee is staying in the accommodation, rented accommodation, that period you have to take. So what is the HRA actually received? Number 2, rent paid minus 10% of salary. So here rent paid also for what period I should take? Rent paid also you have to take for the period during which the employee is occupying the accommodation. Rent paid minus 10% of salary. So here salary is salary 3. Salary 3 means what? Basic salary plus dearness allowance in terms, DA terms, and turnover commission plus turnover commission. So basic pay plus DA terms plus turnover commission. This is only salary 3. In your exam, don't write as salary 3. In your exam, you have to write the entire formula. Okay, that is important. Then, and lastly, 50% of salary for the relevant period. So 50% in case of metro city, however it is 40% in case of non-metro city. And as per Income Tax Act, there are only 4 metro city karna, that is Delhi, Kolkata, Mumbai and Chennai. Delhi, Kolkata, Mumbai, Chennai. There are only 4 metro cities. In these 4 cities, if the employee is residing, then 50% of salary you have to take. In other cities, 40% of salary you have to take. Whichever is lower will be exempt. Balance amount will be taxable. So first in the salary head of income, you have to take the entire HRA and you have to put in the inner column. From that you have to reduce the exemption. To calculate the exemption only, either you can calculate there itself or you can put a separate working note. And in working note you have to calculate HRA actually received or rent paid minus 10% of salary or 50% of salary or 40% as the case may be. Whichever is lower will be the exemption. Okay, now let's talk about the partly exempt allowances given under section 10 clause 14 subclause 1. So 10.14.1 speaks about 6 allowances which are fully exempt subject to official use. It means what? Allowance will be given by the employer. So whenever the employee is using it for official use, that much amount will be exempt. Okay, for example, employer gave 10,000 rupees, but the employee has used 8,000 for official purpose. In such case, 8,000 will be exempt, balance 2,000 will be taxable. You get my point? Now, here also 3 allowances are such which will be exempt under both default tax regime as well as optional tax regime. But there are 3 allowances which is only exempt in the old tax regime or optional tax regime. So firstly, let us see what are all exempt under both tax regime. So first is conveyance allowance. Conveyance allowance is the allowance given for the employee so that they can do the conveyance within the city. Okay, for example, I am working in an auditor office. My client is there in the same city. I am going to the client place and coming back to office. This is only called conveyance. So for this, whatever allowance is given is called conveyance allowance. Then second one is traveling allowance. Traveling allowance means traveling from one city to another city. For that, if I am getting any allowance, that is traveling allowance. Then daily allowance. Daily allowance means when I am going to any other city, I want to meet the expenses of staying there and eating there. Correct? Food expense and hotel expense. So for that only, whatever expense allowance I get, it is called daily allowance. So conveyance allowance, traveling allowance, daily allowance is exempt in both tax regime subject to official use. So whatever amount is incurred for official purpose, that much amount will be exempt, balance amount will be taxable. Now let's talk about old tax regime only. For that, there are 3 allowances. First is uniform allowance. Uniform allowance means what? Allowance for stitching the uniform. So for new uniform, whenever allowance is received, subject to the expenditure incurred on uniform, it is allowed as exemption in the old tax regime. Then is research allowance. So research allowance is for doing the research. That is also only allowed in old tax regime. And lastly, helper allowance. For office work, if any helper is hired, then salary paid to that helper is exempt. Balance amount of allowance will become taxable under old tax regime. New tax regime, all the 3 will be fully taxable. Okay, fully taxable. Now let us talk about section 10 clause 14 subclause 2, partly exempt allowance subject to limit. So now whatever allowance that I am telling you, it does not matter how much amount is used for official purpose or not. Here we are going to study about the limits. Up to the limit, the allowance will be exempt. If it is above the limit, balance amount is going to be taxable. So up to limit exempt, balance amount taxable. Up to limit exempt, balance amount taxable. Okay, so what are they? First, let us talk about the exempt allowance under both tax regime. So it is transport allowance. Transport allowance means what? For transport from office to home and home to office, or office to shop. Home to shop and shop to home. So that is only transport allowance. This transport allowance, if it is given to an employee, that Up to 3,200 per month is fully exempt only in case of specially abled employees. Specially abled means what? Blind, deaf, dumb and handicapped. Blind, deaf, dumb and handicapped. So only in these four cases the entire allowance up to 3,200 per month is exempt. Balance amount will be taxable. But sir, what if the employee is not specially abled? If employee is not specially abled, then entire amount of transport allowance will be fully taxable. Fully taxable. Okay, now Karna, for this both tax regime, no, many students get confused that sir, what are all exempt in both tax regime, what are all exempt only in older tax regime? We are getting confusion, sir. So for that only I have given you a memory technique. What is the memory technique? This sentence you have to remember. I took transport to office, then conveyance to client place, then I had to travel to their outstation branch and work there daily. So once again, I took transport to office. Transport means transport allowance. Okay, so transport means what? From home to office, office to home. That is why I have given transport to office. So that now you remember what is the meaning also, because students get confused in the meaning also. Sir, what is difference between transport, conveyance, travel? So students will get confusion. So you have to be clear. So I took transport to office, then conveyance to client place. So within the city, if you are traveling to client place, it is called conveyance. So conveyance to client place. Then I had to travel to their outstation branch. So in another city you are going and traveling, that is only called travel allowance. And lastly, and work there daily. So there if you are spending for hotel and food, that is daily allowance, correct? So daily. So I took transport to office, conveyance to client place, travel to outstation branch and work there daily. So like this, if you remember, you know these four allowances are the allowances which are exempt in both old tax regime as well as new tax regime. And the first one alone, that is transport, it is subject to the 3,200 limit for specially abled employees, and balance 3, that is conveyance, travel and daily, subject to official purpose, it is allowed to all the employees. Now let us discuss all the other allowances which is only exempt under the old tax regime, only under old tax regime. So what are they? Tribal area allowance or scheduled area or agency area. So up to 200 rupees per month exempt, balance amount taxable. Next, transport system allowance. Transport allowance, system allowance means the daily allowance for transport system employees. For example, a bus driver is there. Bus driver will go to different cities and live there. No, for that they will be getting transport system allowance. So this is also like a daily allowance only. However, if they are also receiving daily allowance, then this transport system allowance will not be exempt. Then daily allowance you can claim the exemption. So they should not be receiving any daily allowance. Now what is the exemption? 70% of allowance or 10,000 rupees per month, whichever is lower. 70% of allowance or 10,000 per month, whichever is lower, will be exempt. Balance amount will be taxable. Next, underground allowance. For example, employee working in mining, okay, who are working underground, for them up to 800 rupees per month is exempt, balance amount taxable. So 800 rupees per month exempt, balance amount taxable. Children education allowance. Children education allowance 100 rupees per month per child, maximum 2 children exempt, balance amount taxable. Hostel allowance 300 rupees per month per child for maximum 2 children exempt, balance amount taxable. Then hilly area allowance, depending on the hilly area it is either 800 or 300, not that important. Then for armed forces also there are some special allowances. What are they? Island duty allowance. So for working in island, okay, up to 3,250 exempt, balance taxable. Next, high altitude allowance. If the altitude is above 9,000 feet but up to 15,000 feet, then 1060, that is 1060 per month exempt, balance taxable. And if the altitude is greater than 15,000 feet, then 1600 rupees per month, 1600, 1600 rupees per month is exempt, balance amount is taxable. Then border area allowance, depending on the area, allowance is given. Then compensatory field area allowance. So compensatory field area allowance up to 2,600 rupees per month exempt, balance amount taxable. Compensatory modified field area allowance. So it is little bit lesser than compensatory. That is why it is 1000 rupees only. 1000 rupees per month exempt, balance amount taxable. Then special compensatory highly active field area allowance. So this is more than compensatory because this is special compensatory. Okay, so 4,200 rupees per month exempt, balance amount taxable. Lastly, counter insurgency allowance 3,900 rupees per month exempt, balance amount taxable. Sir, all these should we remember? Answer is yes. You have to memorize all these thoroughly so that you are able to attend. If you don't memorize, you will not be able to attend. So don't leave all this for the last moment karna. When you are seeing this revision lecture, if at all you are seeing before the examinations, then now itself you sit, spend some time and do complete the memorization part, because one day before the examination it is next to impossible to remember everything. Then it is totally dependent on your luck. If at all something sticks in your brain and if you are able to answer in the exam, well and good, congratulations, you are lucky. But high possible that it forms a khichdi inside your head of all these different limits, terms, formulae, etc. So it becomes very difficult for the examination. So now itself, either you spend some time and memorize, or watch this revision lecture at least 2 to 3 times so that it becomes installed in your brain. Now let's talk about retirement benefits. So allowance is over. Now we are jumping to retirement benefits. Retirement benefits means sum received during the retirement. Firstly, let us talk about gratuity. What is gratuity? Any voluntary payment which is given by the employer in appreciation of employees' services. However, nowadays gratuity is not voluntary. Gratuity has become mandatory to give to the employees. If gratuity amount is received during the service, then gratuity is fully taxable. But if gratuity is received on death or retirement, then exemption can be claimed under section 10 clause 10. Sir, here retirement does not mean only retirement. Here retirement also means termination, resignation or incapacitation. So termination, resignation, incapacitation or death, in all these cases exemption can be claimed under section 10 clause 10. So if a government employee is receiving gratuity on retirement or death, entire amount is exempt under section 10 clause 10. Entire amount received by government employee on retirement fully exempt. Now let's talk about other than a government employee. If it is other than government employee, you have to see whether the employee is covered under Payment of Gratuity Act, that is PGA, or not covered under Payment of Gratuity Act, or we can call it as non-PGA. So PGA case, non-PGA case. First, let us talk about Payment of Gratuity Act, who and all are covered. For them, what is the exemption? So for them, the exemption is maximum 20 lakhs or actual gratuity received, or you have to apply the formula. What is the formula? 15 divided by 26 into salary 2 per month into number of years of services rounded off. What did I say? 15 divided by 26. Sir, how to remember this? Very easy karna. 15 means 15th of August, Independence Day. 26 means 26th of January, that is Republic Day. So Independence Day by Republic Day you have to do. 15 divided by 26 multiplied by salary 2 per month. What is salary 2? We have already discussed. Salary 2 means basic plus dearness allowance. And here in salary, in this PGA calculation, no, this dearness allowance entire DA you have to take. You should not differentiate between DA terms and DA not in terms. Both DA you have to take. So that is why I have given it both. Fine. So basic salary plus dearness allowance is the salary calculation, and number of years of service rounded off. So rounded off means what? Up to 6 months you will do lower rounding, more than 6 months you will do higher rounding. Okay. So that is rounded off. And here for salary, what period salary you have to take, sir? You only have to take last drawn salary. So here average and all is not given, no. That is why you have to take the latest salary or the last drawn salary. So once again, let me tell you what are the exemption limits. Exemption is 20 lakh rupees or actual gratuity, or 15 divided by 26 multiplied by salary multiplied by number of years of service rounded off, whichever is lower. So lower amount will be the exemption, balance amount will be taxable. Now let's talk about non-PGA employees. For non-PGA employees, how to calculate the exemption? So first step, it is 20 lakhs, which is the same. Second step is actual gratuity received, that is also same. Third step only there is a change because the formula is different. Here what is the formula? 1 by 2 into average salary 3. Okay, average. So here it is not latest salary karna, here it is average salary. So average salary 3 multiplied by number of years of services completed. Here it is completed year of service. So here how to calculate the average? Average means you have to take the last 10 months salary before the month of retirement and then you divide it by 10. So that way you will get the average salary. So average means average of last 10 months preceding the month of date or retirement. Okay, death or retirement. And then lastly, number of years of services, you have to take only completed years. So if there is any incomplete year, you ignore it. Only completed years you have to take. So once again, I am telling you, in case of non-PGA employees, how to calculate the exemption. So exemption is equal to 20 lakh rupees or actual gratuity received, or 1 by 2 into average salary into number of years of services completed, whichever is lower. So like this you have to calculate. Now let us talk about one small point, and that is about this 20 lakh limit. This 20 lakh limit is there, no kana? It is a maximum exemption during the lifetime. So for example, if the employee has already received some exemption for gratuity, in such case this 20 lakh rupees limit is there, no? You have to reduce by the exemption that is already received. Hence maximum exemption that can be claimed in the lifetime is only 20 lakhs. So if gratuity is received from 2 or more employers, then aggregate cannot be more than 20 lakhs. And if gratuity was already received before, then limit of 20 lakhs shall be reduced by the income that has already been exempt. Now let us talk about the next part, that is pension. Pension is the periodic payment received for the past services after retirement. So this pension, no, generally it is uncommuted kanna. Uncommuted means what? Received monthly. Okay, every month some amount is received. But if pension is received monthly or quarterly, that amount is fully taxable. It is fully taxable. Then how to claim exemption, sir? To claim exemption, you have to commute the pension. Commuting pension means what? Commuting means giving up the monthly pension and receiving a lump sum amount today itself. Okay, let me give you an example. Let's say a person was receiving 5,000 rupees per month as pension. Now this person is telling, out of this 5,000 rupee per month, no, I want to give up 3,000 rupee per month, so that my future pension is only 2,000 rupees. Future pension 2,000 rupees. 5,000 minus 3,000. If he gives up 3,000, he is receiving 3 lakh rupees as lump sum payment. So this lump sum amount of 3 lakh rupees is only called commuted pension. This commuted pension, no, on this you can claim the exemption. To claim the exemption, you should know certain terms. What is the term? First is commutation percentage. Commutation percentage means what percentage of the pension has been commuted. So 3,000 out of 5,000 has been commuted. No. So how much percentage is commuted? 3,000 divided by 5,000%. 5,000 is equal to 60%. So 60% has been commuted. Then you should know what is the meaning of full pension kanna. Full pension. Full pension means commuted pension divided by commutation percentage. So here it is 3 lakhs divided by 5 lakhs. Or very simple. What is full pension? Full pension means if entire pension is given up, then how much amount will be received in today? That is only full pension. Why we are learning full pension? Because in the formula you will get full pension only to claim the exemption. Now let us see how to claim the exemption kanna. Firstly, if commuted pension is received by a government employee, then under section 10 clause 10a, it is fully exempt. However, in case of other than government employee, you have to see whether the employee is also getting gratuity or employee is not getting any gratuity. Because if the employee is already getting gratuity, then he will be claiming the gratuity exemption also. That is why in Income Tax Act for pension he will receive only 1/3 as exemption. But if he is not receiving gratuity, he will be receiving half amount as exemption. Okay. So if the employee is receiving gratuity, then 1/3 of full pension is allowed as exemption, and if the employee is not receiving gratuity, then half of the full pension is allowed as exempt. Okay kanna. So here you have to put full pension in the formula. So what is full pension? If entire pension is given up, then how much amount will be received? That is only full pension. So 1/3 into full pension or 1/2 into full pension, as the case may be, will be exempt. Balance amount will be taxable. Okay, if you want, you can just pause the video and note down this example so that you are clear with the terms. You can have a sticky note. In this sticky note, you can note this example and stick it on this page so that whenever you want, you can refer. And in pension, no kanna, one thing, 2 silly mistakes the students make. What silly mistake, you know? First silly mistake is that the students get confused and they sometimes think what is the salary they had to take for the pension calculation. Karna, in this pension exemption, there is no salary definition at all. There is only one definition, that is full pension. So 1/3 into full pension or 1/2 into full pension is exempt. So that is one silly mistake. Students get confused. And second silly mistake that students do is that ignoring the balance future pension after the commutation. Now listen, let's say this 5,000 rupees per month is received for 6 months. Okay, after 6 months, the pension has been commuted, so 3,000 is given up. So balance 6 months, how much will be received? For balance 6 months, 2,000 rupee per month will be received. the student make a mistake, silly mistake, that this 2000 rupees per month they are not putting in the answer. This 2000 rupee per month also will be taxable? No, because it has been received after the commutation till the end of the year. So this also will be taxable under salary head of income. So uncommuted pension will be taxable. Commuted pension exemption can be claimed. Sir, what is the exemption? If the employee is receiving gratuity, then 1/3 of full pension. If employee is not receiving gratuity, then 1/2 of full pension will be exempt. Balance amount will be taxable. Okay, wow. Then commuted pension received from annuity plan of LIC is fully exempt. Then commuted pension received by a High Court judge or Supreme Court judge also fully exempt. Then section 10 clause 18, it says that pension received is fully exempt if the following conditions are satisfied. The individual is an employee of central government or state government and has been awarded the Paramveer Chakra, Mahavir Chakra or Veer Chakra. So if an individual is a central government or state government employee who has received the gallantry award means what? Paramveer Chakra, Mahavir Chakra or Veer Chakra. In such case, whatever pension they are getting will be fully exempt. And if the employee is no more, then the family will receive the pension, which is called family pension. Then this family pension is also fully exempt. Okay. And who is family member? Family member means spouse plus children plus parents, brother, sister if they were dependent on the employee. Then exempt disability pension. So disability pension or disability element of pension received by a armed forces personnel who have been invalidated out of service on account of bodily disability attributable to or aggravated by such service is fully exempt. So in armed forces, sometimes what will happen? Sometimes there can be injury for the armed forces person. Because of this injury, now they are disabled and not able to work for armed forces. In that case, whatever amount of pension they get, in that you have to see what is the disability pension. This disability pension will be fully exempt. Fine. So this was the pension discussion. Now let us come to leave encashment karna. Leave encashment means what? How much ever leave was taken, was not taken for this some extra money is received by the employer. This is only called leave encashment. So leave encashment means you are not taking the leave. Since you are not taking the leave, the employer is giving you some extra money. That is leave encashment. Generally, leave encashment is received during service. So generally during service. If it is received during service, it is fully taxable. However, if it is received on retirement, in such case, it will be exempt. How to calculate the exemption? In case of government employee, it is fully exempt under section 10 clause 10AA. Then in case of other than government employee, you have to calculate the exemption, which is the lower of 4 steps karna. So here there are not 3 steps, here there are 4 steps. So step number 1 is the upper limit, that is 25 lakhs. Step number 2, actual leave salary received. Then step number 3, 10 months multiplied by average salary. So 10 months average salary. So 10 months means 10. Then you have to see average salary. Average salary means what? First you should know what is average. Average is the average of the last 10 months salary before the date of retirement karna. So on what date the person retired, before that take the 10 months. For that 10 month salary, find out the average. So 10 month salary divide by 10, you will get the average salary. And here what is the salary definition? Here salary definition is basic salary plus DA terms plus turnover commission. So that is salary 3. So 10 months average salary. Then you have to find what is leave equivalent divided by 30 multiplied by average salary. So leave equivalent by 30 into average salary. So step number 3 was what? 10 months average salary. And step number 4 is leave equivalent by 30 into average salary. Now what is leave equivalent? Leave equivalent means very simple. The leaves that are not taken by the employee. Leaves not taken. See, if at all the question is giving you leaves not taken, then directly you can take it as leave equivalent. Okay, wow. However, if the question is giving you earned leave and actual leave, then you have to do the calculation. Leave equivalent is equal to earned leave minus actual leave. And here the earned leave is there no karna. It can be maximum 30 days per completed year. Maximum 30 days per completed year. So in question, if it is giving you that the employee has earned 45 days per year as leave, then you should not take 45 days as earned leave. You should take only 30 days as earned leave, and only for completed year you have to take. So earned leave minus actual leave will give you leave equivalent, and in formula you have to write leave equivalent by 30 into average salary. Now let me tell you all the 4 steps again. Once again, listen carefully, install it in your brain. So what is the exemption under section 10 clause 10 AA for leave encashment? So number 1, 25 lakhs. Number 2, actual leave encashment received. Number 3, 10 months average salary. And number 4, leave equivalent divide by 30 multiplied by average salary, whichever is lower, where leave equivalent is equal to leave not taken, or you can say earned leave minus actual leave, where earned leave can be maximum 30 days per completed year. Okay, so this is the, and here also similar to gratuity, this 25 lakh rupee exemption is there. No, it is a maximum exemption during the lifetime of the employee. So even if the employee is getting from 2 or more employers, it cannot cross 25 lakhs. Now let's talk about voluntary retirement scheme. So voluntary retirement scheme is where the employee is voluntarily retiring from the organization because the organization is giving a scheme and they are paying a lump sum amount. So this amount, whatever amount is received from the VRS, if the undertaking is an eligible undertaking and if the conditions are satisfied, then it is exempt. However, if it is not an eligible undertaking or if conditions are not satisfied, then it is fully taxable. If nothing is given in the question, you assume that it is eligible undertaking also, conditions are satisfied also. So now if conditions are satisfied, then how much amount of VRS will be exempt? Let us see. Under 10 clause 10C, VRS exemption is lower of the following, and here also there are 4 steps. There are not 3 steps, 4 steps. What are they? Number 1, 5 lakhs. Number 2, actual amount of VRS. Number 3, 3 months multiplied by salary 3 per month into number of years of completed service or number of completed years of service. So 3 months into salary per month into number of years of service. So here it is salary, not average salary. So if only salary is given, then you have to take the latest salary. So 3 months multiplied by latest salary into number of years of services completed. And here completed means what? Only completed years you have to take. And here salary means salary 3, which is basic plus DA terms plus turnover commission. And last step is salary multiplied by balance months of service left. Balance months of service left. So once again I am telling what are the steps. Number 1, 5 lakhs or actual VRS or 3 months into salary into number of years of services completed, and number 4, salary multiplied by balance months of service left, whichever is lower will be exempt, balance amount will be taxable. Okay, next. If nothing is given in the question, you assume, this I have already told. Who is eligible undertaking? Eligible undertaking means central government, state government, any company. So any company is eligible. Then cooperative society, local authority, university, IIT and Institute of Management. So all these are eligible undertakings. Then what is the condition? The condition is that the employee should have completed at least 10 years of service or at least 40 years of age. So 10 years of service or 40 years of age. However, this condition is there. No, it is not applicable to public sector undertaking. Okay, public sector undertaking means what? An undertaking where the government is the majority shareholder. So for this company employee, this condition is not required. Okay, what is the condition? The employee should have at least completed 10 years of service or 40 years of age. Then VRS is a once in a lifetime exemption. So one time if exemption is claimed under 1010C, it cannot be claimed once again. And lastly, if section 89 relief is availed, then for such amount VRS exemption is not there. Now let's talk about retrenchment compensation. Retrenchment compensation means what? Retrenchment means reduction in the number of employees. So the employer is reducing the number of employees and now asking the employees to go out from the organization. This is called retrenchment. In case of retrenchment, the employer will give the compensation as per the Industrial Disputes Act of 1947. So compensation as per Industrial Disputes Act will be exempt under section 10 clause 10B subject to the condition. So what is the exemption? Exemption is number 1, 5 lakh rupees or actual compensation received, or the formula, that is 15 divided by 26 into average salary 3 into number of years of service rounded off, whichever is lower will be exempt, balance amount will be taxable. So here also 15 by 26 you have to take, and here you have to take average. So average I already discussed. No, there are 3 types of average that you have to take care. And then salary 3 means what? Basic plus DA terms plus turnover commission, and number of years of service rounded off means what? If it is up to 6 months, then you do lower rounding, more than 6 months you do upper rounding. So retrenchment compensation, once again I am telling you, 5 lakh rupees or actual compensation, or 15 divided by 26 into average salary into number of years of service, whichever is lower will be exempt, balance amount will be taxable. Now let's come to Provident Fund. Provident Fund is a scheme given to scheme to give substantial benefit to an employee at the time of retirement. So monthly or yearly the employee will deposit some amount in the PF of the employee, and on the time of retirement the employee can withdraw this amount. Employee himself can also contribute. So finally lump sum amount the employee can withdraw and use during the retirement phase. So this is only Provident Fund. Similarly, superannuation fund also similar concept, where regularly amount is being contributed by employer as well as employee, and lump sum amount can be withdrawn later on. So now what are the types of Provident Fund, Kanna? First is recognized Provident Fund. Recognized Provident Fund means what? It is recognized by the Commissioner of Income Tax. Unrecognized Provident Fund means not recognized by the Commissioner of Income Tax. Then Statutory Provident Fund. Statutory Provident Fund means governed by the PF Act of 1925. It is the Provident Fund for government employees. So when the government is putting the money in Provident Fund, that is called Statutory Provident Fund. And lastly, Public Provident Fund. Public Provident Fund is the Provident Fund for all the people other than employees. So for example, if I am not an employee, I can deposit the money in PPF, that is Public Provident Fund. So what are the Provident Fund? Recognized, unrecognized, statutory and Public Provident Fund. Now based on the Provident Fund, let us see what is the taxability. And in case of superannuation fund also, it can be either approved superannuation fund, which means it is approved by Commissioner of Income Tax, or unapproved superannuation fund, which means it is not approved by Commissioner of Income Tax. So now let us study the taxability of everything. So there are 4 types of transactions, Kanna. First transaction is employer contribution, second transaction is employee contribution, third transaction is interest provided by the fund, and fourth transaction is maturity. So in all these 4 transactions, how will the taxability be? Let us see one by one. Firstly, let us talk about Statutory Provident Fund. So Statutory Provident Fund is the Provident Fund for government employees. I told you, no. So employer contribution is fully exempt, so no need to pay the tax. Then employee contribution you have to ignore. Sir, why to ignore, sir? Because when employee is contributing out of his pocket, then for him, is it an income? Answer is no, it is not an income. Then why are we even speaking about taxability? That is why when employee is contributing, it is an expense for the employee. It is not an income for the employee. That is why it is never taxable. So employee contribution should be ignored. However, if you go to the deduction chapter, you will be learning that if employee is contributing, then the employee can claim ATC deduction in the deduction chapter. So that you have to refer the deduction chapter. Now let us talk about interest. So whatever interest is paid by Statutory Provident Fund is fully exempt, and even maturity, section 10 clause 11 says that the entire maturity is fully exempt. So employer contribution exempt, employee contribution should be ignored, interest is exempt, maturity is also exempt. So everything is fully exempt in case of Statutory Provident Fund. Statutory Provident Fund. Now let's talk about Recognized Provident Fund. Recognized Provident Fund means what? Recognized by the Income Tax Commissioner. So in the Recognized Provident Fund, when the employer is contributing, then up to 12% of the salary, if he is contributing, it is exempt. Balance amount will become taxable. So up to 12% exempt, balance amount will be taxable under salary head of income as perquisites. Okay, wow. So this salary means what? Here salary means basic salary plus DA terms plus turnover commission, that is salary 3. Okay, wow. So basic salary plus DA terms plus commission turnover into 12% you have to see. If the contribution is within 12%, fully exempt. If it is above 12%, then balance amount alone will be treated as salary. In question, what you are going to do? In question, first under the salary head of income, you put the employer contribution. Then from that you reduce 12% as exemption. 12% of salary as exemption. Here, no, one silly mistake students do, that also let me tell you. In examination, no, the examiner will tell the employer has contributed 16% of basic salary. But while calculating the exemption, should you take only basic salary? Answer is no. While calculating the exemption, you should take 12% of basic salary plus DA terms plus turnover commission. Like that you have to take all the amount. So here you should not make silly mistake. Okay, students just take 16%, compare it with 12% and give the answer. That is completely wrong. Next, now let's talk about employee contribution. So here also, if employee is contributing, then that can be ignored, and 80% deduction can also be claimed. Then interest up to 9.5% is exempt. Balance interest will be taxable. Now let's talk about maturity. Maturity also under section 10 clause 12, maturity of recognized provident fund is fully exempt. However, it is subject to a condition. In a condition, the condition is that the employee should be a member of a recognized provident fund for at least 5 years. So before 5 years, you should not withdraw the amount. If before 5 years you are withdrawing the amount, then the maturity is going to be taxable. Sir, but for this 5 years, there are some exceptions. What are the exceptions? Number 1, transfer of funds from the old employer RPF to new employer RPF is allowed. So for example, within 5 years itself, you are shifting from the employer to another employer. However, the recognized provident fund money is there, no, that you are not withdrawing. Instead of withdrawing, you are transferring it to the new employer. So that case, it is not taxable. Similarly, if you are transferring from old employer recognized provident fund to NPS under section 80 CCD, then also it is not taxable. So conversion from RPF to NPS, new pension scheme or national pension scheme, that is also not taxable. And then there are 3 exceptions where even if you withdraw within 5 years, still it will be exempt. Exception number 1, due to ill health of the employee. So the employee is suffering from some disease, for the treatment only they are getting that money. So it is fully exempt. Number 2, discontinuance of employer business. The employer itself has stopped doing business, hence now you are forced to get the money from the PF. Hence, it is fully exempt. And third one, any other cost beyond the control of employee. Now it is not in the employee's hands. The employee has to forcefully get the amount from RPF. In such case also it is exempt. So what did I say? Recognized provident fund, very important kana. In recognized provident fund, when they look at my face, don't look at the screen, look at my face. Employer contribution. If the employer is contributing up to 12% of basic plus DA terms plus turnover commission is exempt, balance amount is taxable under the salary head of income. When it comes to employee contribution, you have to ignore it, but you can claim deduction under section 80C for employee contribution. When there is interest up to 9.5% per annum, it is exempt. Balance amount of interest will be taxable. Sir, what about maturity? Maturity is generally exempt. However, if you withdraw the money within 5 years, then the maturity will be taxable. But for this 5-year condition also, there are some exceptions. What is the exception? Number 1, you can transfer the money from recognized provident fund to new employer recognized provident fund, or you can transfer money from RPF to national pension scheme, that is NPF, or you can withdraw due to any of the 3 reasons, that is ill health, discontinuance of employer business, or any other reason beyond the control of employee. So if all these conditions are satisfied, any of these conditions are satisfied, then maturity will be exempt even if the amount is being withdrawn within 5 years. After 5 years, however, it is exempt, not a problem. Okay, so I hope you are clear. Now let us talk about unrecognized provident fund. Unrecognized provident fund, employer contribution is not taxable. Employee contribution also you should ignore, but in case of unrecognized, there is no ATC deduction also. Then interest also is not taxable, but maturity will be taxable. Employer contribution not taxable, employee contribution ignore, there is no ATC deduction also, interest also not taxable, but maturity will be fully taxable. How to tax the maturity, sir? In the maturity amount, no, you have to divide it into 4 parts. Okay, so first part is employer contribution, second part is employee contribution, third is interest on employer contribution, fourth is interest on employee contribution. So now employer contribution and interest on employer contribution will be taxable under salary head of income. Then interest on employee contribution will be taxable under income from other sources head of income, and employee contribution is never taxable because it is the amount spent by the employee. Okay, so this is the taxability of unrecognized provident fund on maturity. And you know what? If a recognized provident fund is withdrawn within 5 years, I told you no, it is taxable. If the conditions are not satisfied, it will be fully taxable. Then that also will be taxed like this only. So even recognized provident fund, if it is withdrawn within 5 years, it is taxed the same way as unrecognized provident fund. However, sometimes no, some amount will already have been taxed. For example, in recognized provident fund, if the contribution is more than 12%, already it would have been taxed. So if any amount has been taxed already, that much amount you don't tax during the time of maturity. So let me read the sentence for you. Maturity of a recognized provident fund is taxable if it is taxable due to not satisfying the condition, it will be taxed in the same manner as unrecognized provident fund. However, the amount already taxed, if any, will not be taxed once again. So the next paragraph you can cut because I have repeated it again in the next page. 2 times it has come in your book. Fine. So now recognized provident fund over, unrecognized provident fund over. Now let us discuss about public provident fund. So for public provident fund, employer contribution not applicable. Then employee contribution you can claim deduction under section 80C. Interest is exempt, maturity also exempt. Now let's talk about superannuation fund. Superannuation fund can be approved or unapproved. First let us talk about approved superannuation fund. Approved superannuation fund, employer contribution fully exempt. Then employee contribution can be ignored. However, employee can claim 80C deduction. Then interest will be fully exempt. Maturity also is received on death or retirement. It will be fully exempt. Then unapproved superannuation fund. Unapproved superannuation fund is taxed the same way like unrecognized provident fund. So for them both it is the same treatment. Okay. So I hope you are clear. Now let's talk about second level Kanna. So first level we have studied. Now let us see second layer. What is the second layer? Second layer is the perquisite as per section 17(2)(7), which is excess employer contribution. There is one more section called section 17(2)(7), which says that aggregate of employer contribution in any of the following in excess of 7,50,000 shall be taxable perquisites. And what are the three? Recognized provident fund, national pension scheme, approved superannuation fund. If all the three funds combined, if the employer contribution is more than 7,50,000, then the excess amount will be taxable in the hands of employee. So maximum 7.5 lakhs. So first level, what did we see? 12% of salary. Correct? What is the second level? Second level is that recognized provident fund plus NPS plus approved superannuation fund. All the three put together 7,50,000. If it is more than 7,50,000, then the excess amount is taxable. Moreover, section 17(2)(7)(a) tells that whatever amount has been taxable due to 17(2)(7), which is excess of 7.5 lakh rupees, then interest on such amount also will be taxable under 17(2)(7)(a). Okay, and not only in the same year, next year also whatever interest is coming because of the previous year's taxable amount will also be taxable. So if a perquisite is taxable under section 17(2)(7), annual accretion, that is interest on such amount by way of interest, dividend or any other amount of similar nature shall be considered as a perquisite in the hands of employee. So first what did I say? Amount in excess of 12% is going to be taxable in recognized provident fund. Then what did I say? Second layer. Second layer I told you that if any amount of employer contribution in all the three funds combined is more than 7.5 lakh rupees, then the excess amount is going to be taxable. And third layer is the interest. Interest on such excess amount also is going to be taxable. And next year also whatever interest is received on the taxable amount as well as interest. So interest on the taxable interest also will be taxable. Sir, this 7.5 lakh rupees easy to calculate, but how to calculate this taxable interest? For this, it is sounding complicated. No, the formula is also complicated. So what is the formula? To calculate the taxable interest under section 17(2)(7)(a), you have to apply a formula. So the formula is PC divided by 2 multiplied by R plus PC1 plus TP1 multiplied by R. So PC, what is TP? TP means taxable perquisite karna. Taxable perquisite under section 17(2)(7)(a). So TP means taxable perquisite. Then is equal to PC divided by 2. So what is PC? Perquisite contribution. Perquisite contribution means the contribution which is more than 7.5 lakh rupees. So that is only perquisite contribution. So perquisite contribution divided by 2 multiplied by R. R means what? R means rate. And rate means I divide by F average. How to find out the rate? I divided by F average. So income divided by average of funds. Income of funds divided by average of funds is equal to rate. So what is I? I means income. Income means what? The aggregate income from RPF, NPS and approved superannuation fund combined. And then what is F average? F average means average of funds. So you have to take what is the opening balance, then add the closing balance, divide by 2. That only will give you the fund average. So what did I say? That first TP, taxable perquisite, is equal to PC divided by 2 multiplied by R plus PC1 plus TP1 multiplied by R. Sir, now what is this PC1? What is this TP1? PC1 and TP1 means this section Nogana, it was started from 1/4/2020 onwards. So from 1/4/2020 till 31/3/2025, what are all the PC you have to add it together. So it will become PC1. Similarly, from 1/4/2020 to 31/3/2025, what are all the TP that you had find out in that year, you have to add all of them together. That is only TP1. So PC1 means the sum of PC of the past years and TP1 means sum of the taxable perquisite of the past years. And here also you have to multiply by R. So once again, what is TP? Taxable perquisite is equal to PC divided by 2 multiplied by R plus PC1 plus TP1 multiplied by R, where PC is equal to perquisite contribution during the year, R is equal to I by F average, means income of funds divided by average of funds. Income of funds means the interest received during the year, and average of funds means opening balance plus closing balance divided by 2. Then what is PC1 and TP1? PC1 and TP1 means sum of all the perquisite contribution of all the years from 1/4/2020 onwards, and TP means sum of TP1 means all the sum of all the taxable perquisite in all the years from 1/4/2020 onwards till the preceding previous year multiplied by R. So this formula you have to remember and apply it. There is one question in your study material, beautiful question. Definitely solve that question to get a grip over this formula. Okay, if you solve the question, no, then it will become very easy. And formula you have to remember for sure. Now let's talk about excess employee contribution. This is level number 4 Kanna. So first level means the 12% level, okay, of RPF. Second level is 7,50,000 kumala. However, how much ever employer contribution is there, that will be taxable. Then third level is the interest on such employer contribution also will be taxable. And fourth level, interest on excess employee contribution also will be taxable. So now let us read. Exemption under section 10 clause 11 and 10 clause 12 shall not be available in case of employee contribution. Kana, can employee contribution be taxable? Answer is no. Employee contribution is only the amount spent by the employee, hence it is never taxable. But interest on employee contribution is going to be taxable if the employee contribution is more than 2,50,000 rupees per annum. So if employee contribution is more than 2,50,000 per annum, then on the excess amount, whatever interest is coming, it is going to be taxable. However, if employer is contributing, then it is 2,50,000. But if employer is not contributing, then the employee can contribute 5 lakhs also, not a problem. So if employer is contributing, then up to 2,50,000 only can be contributed. But if employer is not contributing, then up to 5 lakhs can be contributed by the employee. Balance amount is there, no? On that the interest is going to be taxable. So in such case, what should the employee do? The employee will maintain 2 accounts Kanna. The employee will maintain non-taxable contribution account and taxable contribution account. In non-taxable contribution account, they will have closing balance as on 31/3/2021. You know why? Because this section started from 1/4/2021 onwards. 1/4/2021 onwards. Plus contribution made which is not taxable, that is up to 2,50,000 or 5 lakhs as the case may be, and whatever is the interest on above has to be taken in the non-taxable account. Then in the taxable account, first you take contribution on or after 1/4/2021 exceeding the limit of 2,50,000 and 5 lakh rupees plus interest on the amount minus withdrawal from the account. So Kanna, this part is there, no? Practically it is not going to be tested in your examination. If at all, theoretically it can be tested, or if practical question comes for the employer contribution part, that is 7.5 lakh rupees, this TPPC and all, then you also have to write about the employee contribution. Okay, so this same question, if you see in their study material, no, the same question, you will also have a note about this employee contribution. Make sure to read that note also, so that you are thorough with the provision. Now let's talk about Agnivir Corpus Fund. whatever amount has been contributed to Agniveer Corpus Fund, entire amount should be added to the salary head of income. So employer contribution added to the salary head of income. However, in the deduction chapter, we are going to learn that amount is allowed as deduction. So employer amount first you add to salary head of income. Later on, you can claim the deduction in the deduction chapter. Fine. Agniveer Corpus Fund. Now let us discuss the perquisites under the salary head of income. Let's start with the fully exempt perquisites. Firstly, section 10 clause 7 is there, which tells that if the Indian government is giving any perquisite to an Indian citizen outside India, it is fully exempt for that Indian citizen. Then, if the employer is providing any telephone to the employee at his residence, that is also fully exempt. Then, any transport facility provided to airline or railway employees, that is also fully exempt. Then training of employees or any amount paid for management course, including the expense of boarding and lodging, also fully exempt. So management training fully exempt. And then rent-free official residence provided to High Court and Supreme Court judge in the old regime, it is fully exempt. And then conveyance facility provided to High Court and Supreme Court judge in the old regime, it is fully exempt. So these are all the fully exempt perquisites. Now let us talk about partly exempt perquisites. Partly exempt perquisites means what? Some part of the perquisite might be exempt, some part of it might be taxable. So let us discuss. Firstly, let us discuss the 5 perquisites which are fully exempt for the non-specified employees, only taxable for specified employees. Okay, the 5 perquisites we are going to see, starting with motor car facility. So motor car facility, very important from examination point of view. Multiple times it is tested, maybe for 1 marks or maybe a full question also can come. Motor car facility means what? The motor car is provided to the employee for driving for the official purpose. It can be personal also. So if at all the motor car is used for fully official purpose, if only it is used for official purpose, in such case it is fully exempt. The facility is not taxable. For this, how to prove that it is official purpose? So for that, the employer should maintain the details of the journey undertaken for official purpose. The employer should also give a certificate that the expenditure was incurred wholly and exclusively only for performing the official duties. So if employer is giving this declaration, in such case, then the entire perquisite is exempt in the hands of employee. Okay, but what if the employee is only using for personal purpose? If the employee is only using for personal purpose, then first let us see whether the employer has provided his own car or employer has provided a hired car. Means employer has taken the car on rent and given to employee. If the employer is only having the car, if it is own car, in such case 10% of the cost of the car will be treated as perquisite in the hands of employee, and over and above that you also have to add the driver salary which is paid by the employer, and also the running and maintenance expenses paid by the employer. Running and maintenance expense means fuel expense, insurance expense, repair expense, etc. So if there is employer's car, then 10% of the cost plus driver salary plus running maintenance expense. However, if it is a hired car, then you have to take what is the higher charges paid by the employer, that will be treated as perquisite in the hands of employee, plus driver salary plus running and maintenance expenses. But you know what, in examination they don't ask official purpose, they don't ask personal purpose, they only ask partly official, partly personal purpose. So this is only more important from examination point of view. So partly official, partly personal purpose, it means what? The employee is using for personal purpose also, for official purpose also. In such case, what to do? In such case, you have to see whether the car belongs to the employee or car belongs to employer. If car belongs to employee and running and maintenance expense also is paid by employee himself, then there is no perquisite at all, because all the expenses are by employee himself. That is why it is not taxable. But if car belongs to employee, running and maintenance expense alone, if it is paid by employer, then you have to see what is the charges paid by the employer. From this charges paid, you have to reduce 1800 per month or 2400 per month, as the case may be. The balance amount will be treated as perquisite. Sir, when 1800 per month, if the car capacity is up to 1600 cc or up to 1.6 liter engine, it is 1800 per month. And if it is more than 1600 cc or more than 1.6 liter engine, then you have to take 2400 per month. So what you have to do, if the car is employee's car but running and maintenance expense is paid by employer, then first take what is the charges paid by employer. From that you reduce 1800 per month or 2400 per month as the case may be. So you will get the perquisite value. Then what if the car is employer's car and running and maintenance expense is paid by employee? If car is employer car, running and maintenance is paid by employee. In such case, the perquisite value shall be 600 rupees per month up to 1600 cc car and 900 rupees per month for more than 1600 cc car. So 600 per month or 900 per month as the case may be. Then last one, if the car is the employer car and running and maintenance also paid by employer only. So this is only most important, most frequently asked in the examination. Car also employer car and expense also paid by employer. In such case what to do? Then the perquisite value shall be 1800 per month or 2400 per month as the case may be. So this is the perquisite calculation. Over and above that, if the employer is also giving driver, then for the driver, don't include driver salary kanna. For driver, you should only include 900 rupees per month. 900 rupees per month. So this is the calculation of motor car facility. This motor car facility will be fully exempt for non-specified. It is only taxable for specified employees. Now let us talk about education facility. This is also fully exempt for non-specified. Now let's talk about specified employee. In case of specified employee, if the employer is sponsoring the education of employee himself or herself, in such case it is fully exempt. But other than that, if he is sponsoring for employee children, then what to do? Then there are two conditions kanna. If both conditions are satisfied, it is fully exempt. If one of the condition also not satisfied, it is fully taxable. Fully taxable. What are the condition? The value of education should be up to 1000 rupees per month per child. 1000 rupee per month per child. And second condition, the school should be either employer's own school or it should be a tie-up school. So either employer himself should be having the school or it should be a tie-up school of the employer. In such case, if both conditions are satisfied, then the education of children is also facility is exempt. Otherwise, it is fully taxable. Fully taxable. Kanna, sir, this up to 1000 rupees per month per child you told. No. What if the education is 2000 rupee per month per child? Then what will happen? In such case, the 2000 rupee per month per child entire amount will be fully taxable. Okay, this 1000 itself we should not take. If it is excess, entire amount will be taxable. Kana in salary chapter, no, you have three places. Okay, wow. First place is this education. Second place is gift. There also we will be learning that gift up to 4999 is exempt. More than 4999 will be fully taxable. And then you will have meals, where up to 50 rupees per meal it is exempt. More than 50 rupees fully taxable per month per child. In all these three cases, you are having an option. Okay, well, there are two methods to solve the question. Both methods are correct karna. Either you can take up to 1000 exempt and balance amount will be taxable. That method also you can follow. Or you can follow the method where if it is within 1000, it is fully exempt. If it is above 1000, it is fully taxable. That method also you can follow. Similarly, when it comes to gift also, if it is up to 4999, it is fully exempt. Above 4999, it can be fully taxable also, or only the excess amount is taxable. Like that also you can solve the answer. Similarly, if it is meals, up to 50 rupees per meal, it is fully exempt. Above 50 rupees per meal, it is fully taxable. Like that also you can solve. Or up to 50 rupees exempt, balance amount is taxable. Like that also you can solve. It is totally your wish. Fine. However, I teach to my students only one method, that is in all the three cases, if it is up to 1000 rupees per month, then it is exempt. If it is exceeding, then tax the entire value. Entire value has to be taxed. In case of education also, gift also, meals also. So all the three cases you remember, I am not going to repeat once again. So in case of education, for children, if the value of education is up to 1000 rupees per month per child, and if it is an employer school or tie-up school, it is exempt. Otherwise, it is fully taxable. And what if the employer is sponsoring any other person's education? In such case also, it is fully taxable. Now let's come to free tickets. Okay, well, in case of non-specified employees, free ticket is fully exempt. But in case of specified employee, then if the employee is an airline or railway employee, then whatever amount is received, whatever ticket is received from the respective airlines or railways will be fully exempt. But other than airline or railway employees, it will be fully taxable. Okay, so if Indigo Airlines employee is getting Indigo ticket, then that Indigo ticket amount is fully exempt for them. If railway employee is receiving railway ticket, it can be privilege ticket also, then also it is fully exempt. Now let's talk about domestic servant. This also I told you, sweeper, gardener, watchman, personal attendant, it is exempt in the hands of non-specified employees but taxable in the hands of specified employees. So if salary of domestic servant, if it is paid by employee and reimbursed by the employer, then it is an obligation of the employee met by employer. In such case, it is taxable for both specified as well as non-specified. This also we had already discussed. Then gas, electricity, water supply. This also we have already discussed. If it is directly paid by the employer, then it is exempt for non-specified, taxable for specified. But if it is not directly paid, instead if it is reimbursed by the employer, then it is an obligation of the employee met by the employer. Then it will be taxable for both specified also, non-specified also. Now let's talk about leave travel concession. Leave travel concession LTC exemption can be claimed under section 10 clause 5 under the old tax regime, not allowed under section 115 BAC. So only old tax exemption is allowed. In new tax regime, that is default tax regime, exemption is not allowed. Exemption is not allowed. Fine. So what is the value of exemption for leave travel concession? First, whatever amount is LTC, you put it in the salary head of income. From that, you reduce the exemption under section 10 clause 5. If the travel has been taken through air, aeroplane, in such case, exemption will be economy fare of the national air carrier, Air India, or actual expense, whichever is lower. However, if it is other than air, then you have to see whether railway service is available for that route. If railway service is available for that route, then first class railway fare or actual expense, whichever is lower. But if railway fare is not available for that route, then you have to see whether recognized public transport system exists. If recognized public transport system exists, for example, government bus facility, in such case you have to see deluxe class fare or actual expense, whichever is lower, it will be exempt, balance amount taxable. Then if recognized public transport system does not exist, then first class railway fare of a similar distance or actual expense, whichever is lower, will be exempt, balance amount will be taxable. And here this fare is there, this you have to take only for the shortest route. And LTC expenses can be paid by the employer for employee also and employee's family member also. And here you have to be thorough with the family member definition. Who is family? Family means spouse, children, parents, brothers, sisters if they are dependent. So children, parents, brothers, sisters alone if they are dependent on the employee. And for children also there is one rule that before 1998 there can be any number of children. But on or after 1998, if the children are born, then there should be maximum 2 children. However, first if one child was born and in the second birth there are multiple births, then such children in multiple birth also allowed. For example, twins born after one child born on or after 1/10/1998. In such case, for all the children, the exemption will be allowed. So what did I say? Here, the employer can sponsor the ticket leave travel concession for employee also, for family member also. Exemption can be claimed for both employee also, for family members also. Who is family member? Family member means spouse plus children plus parents, brother, sister if dependent on the employee. And here there is a maximum limit on the children. If the children are born before 1/10/1998, then there is no limit. But if the children are born on or after 1/10/1998, in such case maximum 2 children. However, if first child is born and in second birth, if there is multiple birth, so twins are born or triplets are born, in such case multiple birth also will get the exemption benefit. But sir, what if first there is multiple birth, sir, then one child is born, then can all child claim exemption? Answer is no. If there is multiple birth in the first birth itself, then the parents should have stopped there itself. They need not plan the third kid. That is why after multiple birth, whatever children is there, for that it will be taxable. Fine. In our regular batch, we generally have a comedic discussion, long discussion about this LTC, but definitely in revision lecture, all of that is not possible. So be thorough with the family definition. Okay. Leave travel concession. This benefit of exemption is there, no kanna. It is allowed only 2 times in a 4 calendar year block. So what is the block going on now? Now what the block going on is 1/1/2022 to 31/12/2025, which is for your examination. So between this period, for 4 years, for two times LTC benefit can be claimed. More than 2 times it cannot be claimed. But sir, what if it is claimed less than 2 times? Can I forward the LTC to the next block? Answer is yes. If you claim less than 2 times, then maximum 1 LTC you can carry forward to the next block, and in next block you can claim 3 times also. That is also allowed. So if one or both of the LTC is not available in the entire block, then 1 LTC can be carried forward to the next block. And here there is a condition that the travel should only be within India. For foreign travel and all, LTC benefit is not allowed as exemption. Then LTC can be given after retirement also, still exemption can be claimed. LTC to High Court judge and Supreme Court judge is fully exempt in the old tax regime. In new tax regime, it is fully taxable. Fine. So this is the relief travel concession. Now let us talk about medical facility. Medical facility no karna, for examination point of view, I feel it is very important, because separate question can also be asked. It can be asked for 1 or 2 marks in total income question also. It can come in multiple choice question also, and there is amendment also. That is why it is one of the favorite question for May 26, September 26, Jan 27. So listen carefully. Medical facility karna. Firstly, let us talk about treatment in India. What happens if the employer is either sponsoring or himself he is giving the treatment of the employee or family members in India? Here, employee can also get the treatment, family member can also get the treatment. Sir, who is family member? This family member definition is there, no? It is similar to LTC, that is spouse plus children plus parents, brother, sister if dependent on the employee. But here it is a medical purpose, that is why there is no limit on the number of children. Okay, wow? So spouse, children, parents, brother, sister if dependent on the employee. So they can claim the benefit. And here you have to be thorough with family definition, because if they give the question in the examination, no, they will be playing with that only. See, they will give, what if the treatment for grandfather has been done, can the benefit be claimed? Answer is no. For grandfather, the grandfather is not considered as family member as per this definition. That is why no benefit. Sir, what if sister is there but sister is not dependent? In such case, can the benefit be given? Answer is no. It is not exempt. It will be fully taxable. But if the benefit is given to children, and if children are not dependent, still can the children claim the exemption? Answer is yes. Children need not be dependent kana. However, parents, brothers and sisters need to be dependent on the employee. So be very thorough with the family definition. Now let's talk about the provision. When can exemption be claimed? Treatment is fully exempt if any one of the conditions are satisfied. So there are 4 conditions. If any one condition is satisfied, then the treatment expense which is sponsored by the employer will be fully exempt. So what is the first? Treatment should be in employer's own hospital. Let's say the employer itself is Apollo Hospital and the employee treatment is sponsored in Apollo Hospital. In such case, it is not taxable in the hands of employee. Then treatment in government hospital. Government hospital also includes local authority and approved by government. So if it is a government hospital or approved hospital, and if treatment is done in that hospital, then it is fully exempt, not taxable. Then in respect of prescribed diseases, if there is any prescribed disease like cancer, etc., in such case, sometimes in government hospital, no, treatment will not be given. In that case, principal chief commissioner or chief commissioner will give approval for the private hospitals. In that approved hospital, if you go and get the treatment done, then it is fully exempt. Even if employer is sponsoring, it is not taxable. Then in respect of illness related to COVID-19, subject to conditions. So subject to condition, even COVID-19 treatment will not be taxable. So what are the 4 conditions? Either treatment should be done in employer hospital or in government hospital, or it should be a prescribed disease and approved hospital. In such case, the treatment sponsored by the employer will be completely exempt, or else it will be taxable. Then, sir, what if treatment is done outside India? If treatment is done outside India, first let us talk about treatment expense and stay expense. Then we will talk about travel expense. Okay, wow. First, what about treatment and stay? If treatment and stay for foreign medical treatment is sponsored by the employer, in such case, actual expense by the employer for treatment subject to RBI limit will be exempt. So up to RBI limit it will be exempt. If it is above RBI limit, it will be taxable. But what about travel, sir? Traveling from India to the foreign country. For that you have to see what is the gross total income of the employee. If the gross total income is up to 8 lakh rupees, then it is exempt. But if gross total income is more than 8 lakh rupees, then the travel expense will be treated as perquisite in the hands of employee. So once again I am telling, For treatment, sir, who can get treatment? Employee can get treatment and family member can get treatment. On for whom the employer can incur expense? Employer can incur expense for the patient also and one attendant. Maximum one attendant can go. So patient plus one attendant, treatment expense plus stay expense up to RBI limit will be exempt. And in case of travel, if the gross total income of the employee is up to 8 lakh rupees, then the travel is also exempt, or else the travel will be taxable in the hands of employee. Fine. So I hope you are thorough. Now let's talk about insurance. What if insurance premium is paid by employer? So if health insurance is paid by employer, it is fully exempt. Then if health insurance is paid by employee and if it is reimbursed by employer, then also it is fully exempt. Personal accident policy also exempt, staff group insurance also exempt. But remember, life insurance fully taxable. So health insurance exempt, reimbursement of health insurance exempt, personal accident policy exempt, staff group insurance policy exempt. But life insurance policy taxable. Life insurance policy taxable. Okay, wow. Then here hospital includes dispensary and nursing home also. So both of them also will be considered as hospital. Then so this is medical facility. Now let us talk about free food. If food is sponsored by employer, then how to tax that food? First let us talk about alcoholic beverage. Alcoholic beverage is always fully taxable. Fully taxable. Then tea, coffee and refreshments. So tea, coffee, bhaji, bonda, snacks, whatever is given by the employer, it is fully exempt. It is not taxable. What about other than that? If full meals has been sponsored by the employer, in such case you have to see whether the employee is working in a remote area. If employee is working in remote area, it is fully exempt. But if employee is working in normal area, then you have to see whether it is default tax regime or old tax regime. If it is default tax regime, it is always fully taxable. But in old tax regime, up to 50 rupees per meal, up to 50 rupees per meal, if it is directly given or given in the form of voucher, it will be exempt. And if it is more than 50, it is fully taxable. So up to 50 it is exempt, more than 50 fully taxable. Okay. Now let's come to club facility. Club facility is given by employer to employee. Firstly, let us talk about fitness club. So if fitness club facility is given, like health club, sports club or similar facility is given to all the employees in general, then in such case it is fully exempt. But other than fitness club, if it is given, then you have to see whether the employer has taken corporate membership or other than corporate membership. If the employer has taken corporate membership no kanna, then you cannot find out what is the per employee cost, because corporate membership will be a lump sum amount. Hence, initial expense by the employer will be exempt, but remaining expense will be taxable. Remaining expense will be taxable because in initial expense you cannot find out what is the per employee cost, because it is a lump sum amount. So initial expense, it is exempt, but remaining expense, if the employer incurs any additional expense on behalf of the employee, that will be taxable. And in case of any other case, whatever expense is incurred by the employer will be taxable in the hands of employee. But here also this club is there, no? It can be for official purpose. Official purpose means what? The employer should maintain the details of expense for official purpose, and the employer should give a certificate that the expenditure was incurred wholly and exclusively for official duty. If both conditions are satisfied, then this club fee amount is there. No, it is not taxable. So only if it is not official purpose, it will be taxable. The same condition we also saw in motor car facility already. Same we are also going to see one more time in credit card facility. So in all these three facilities, this official purpose is there. Now let's talk about travel, tour or accommodation sponsored by the employer other than LTC. So other than LTC, if the employer is sponsoring a tour, you have to see whether it is an official tour. If it's an official tour, then whatever amount is spent for the employee will be completely exempt. But if they spent for employee's family member, it will be taxable. Okay. But if it is an official tour extended to vacation, so first official tour was there, later on it is extended to vacation. Then in such case, official stay is there, no, that will be exempt, but vacation stay will be taxable. Then what if it is not official tour? If it is not official tour, then whatever amount is incurred, no, that will be taxable as perquisites. Now let us talk about credit card. So credit card also I told you, membership fees, annual fees, reimbursement of credit card expense is fully taxable. However, if credit card expense has been incurred for official purpose, it will not be taxable. Now let us talk about Other taxable perquisites, let us start with rent-free accommodation. Rent-free accommodation is important, very important from the examination point of view. So let us discuss this. In your institute study material, this will be at least for 8 to 10 pages, this one discussion. But I have tried to sum it up all in just one single chart so that it is very easy for you to memorize. So I have done my hard work. Now you have to do your hard work of by hearting all this. Okay, wow. So rent-free accommodation. Rent-free accommodation means what? The accommodation which is given to the employee by the employer, where the employee will either not pay any rent or the employee will pay just some concessional amount of rent. That is only rent-free accommodation. You can also call it as RFA. Okay, wow. Now for this RFA, you have to see whether government employee is getting or other than government employee is getting. For government employee, the license fee prescribed will be treated as taxable perquisite. Listen Kanna, for RFA, no, there is no exemption at all. Fine. So don't get confused. In case of government employee, there is no exemption. We are only discussing how to calculate the value of perquisite. Okay, wow. So value of perquisite is equal to license fee prescribed by the government. So whatever is license fee, that will be taxable in the hands of employee. Now other than government employee or a government employee where there is no license fee available. So how to calculate? First you see whether the property is a employer property or other person's property. Employer property or other person's property. If it is the employer property, then you have to calculate 5% or 7.5% or 10% of salary as the perquisite. So 5%, 7.5% or 10%. 5% if the population was up to 15 lakhs, 7.5% if the population was up to 40 lakhs, and 10% if the population is more than 40 lakhs. So in the examination, if you get any city like Mumbai, Delhi, Chennai, Kolkata or such cities, Bangalore, etc., there definitely the population will be more than 40 lakhs. So don't put an assumption and all that I assume that the population is going to be more than 40 lakhs and solve the question. Directly you can solve the question, no problem. But if it is some other city, then the population will be given. Okay, don't worry. So if population is up to 15 lakhs, 5% of salary will be perquisite. If population is up to 40 lakhs, 7.5% will be perquisite. If population is above 40 lakhs, 10% of salary will be perquisite. And here what is salary, Kanna? Here salary is a definition that you have to memorize, and that is ABBCDM minus AAPR. So ABBCDM minus AAPR. It means what? Take all the allowances that are taxable. All the allowances that are taxable. Then basic salary, bonus, commission. And here you have to take both commission, turnover also, other than turnover also. There is no differentiation. But in dearness allowance, you have to take only DA in terms. DA in terms. So commission means all the commission, but DA means only the DA in terms. Then all the monetary payments, but do not include advance salary, arrears of salary, perquisites, PF contribution by employer, retirement payments. So what you should take all the taxable allowance, basic salary, bonus, commission, DA in terms, and all the other monetary payments. But don't include advance salary, arrears of salary, perquisites, PF contribution by the employer, and retirement payments. So this should not be included. So what you should take, one more time, very important. So what you should include: allowable taxable allowances, basic salary, bonus, commission, both commission, then DA in terms, and then all the monetary payments. But don't include advance salary, arrears of salary, perquisites, PF contribution, and any other retirement payment should not be included. So this definition you have to remember. Multiplied by 5%, 7.5%, 10% as the case may be, will be the value of the perquisite. Then what if it is other person's property? In such case the employer will be paying the rent, no? So see what is the rent paid by the employer and compare it with 10% of salary. Here also salary definition is the same. Whichever is lower will be the perquisite. So 10% of salary or rent paid by employer, whichever is lower will be the perquisite value. Then after finding out this value, you also have to add the value of the furniture that has been provided by the employer. How to add the value of furniture? You see whether the furniture is the employer furniture or it is other person's furniture. If it is employer furniture, then 10% of cost of furniture will be the value of perquisite. If it is other person furniture, then the higher charges paid by the employer will be treated as perquisite. Okay, so first take RFA value, then add furniture value, then you have to reduce the rent recovered. So RFA value plus furniture value, then reduce the rent recovered from the employee. Rent recovered means what? Whatever rent is being paid by the employee, that you have to reduce. So after doing this calculation only, you will find out the RFA value. So RFA means what? Rent free accommodation is equal to RFA perquisite value plus furniture value, okay, minus rent recovered. With this formula you will find out what is the final RFA value. From this you also have to do comparison with the last year inflated amount. So for example, last year whatever rent free accommodation value was there, no, that you have to do the indexation and bring it to current year price. So how to do that? See, the whatever is the value of the perks last year multiplied by cost inflation index of the previous year, that is 376, divided by cost inflation index of preceding previous year, that is 363. Sir, should I remember this? Answer is yes, please remember this. If at all they don't give in the question, you should be able to answer. Mostly they will give in the question, but still if they don't give in the question, you should be able to answer. So perks in the preceding previous year multiplied by cost inflation index of the previous year divided by cost inflation index of preceding previous year. So perquisite value, whatever you are getting for previous year, 2425, correct? 25 multiplied by 376 divided by 363. So this is what? This is the maximum perks in the current year. So if whatever value you are getting after doing this calculation, if it is more than the maximum value, then restrict it to the maximum value. So maximum perks can be how much? Previous year 2425 value multiplied by 376 divided by 363. So this is the formula. So once again I am telling you how to find out RFA. First find out the perk value of the property, then add the perk value of furniture, then reduce the rent recovered by the employee. Whatever value is there, that value you compare it with the inflated value of the preceding previous year. So how to find out that inflated value? Take the preceding previous year value multiplied by 376 divided by 363. So you will get the value. This is the maximum perks during the previous year. So if the calculated perks is more than the maximum perks, then restrict the perks amount to the maximum value. So like this you have to do the calculation. Then salary should only be taken for the period during which the employee was occupying the accommodation. Then if the employee is transferred and given two accommodations, so for example, let's say employee is living in Chennai, now transferred to Mumbai. So in Chennai, family and all will be there, no? So sometimes employer will give two houses, one house in Chennai also, one house in Mumbai also, for a temporary period. In such case, what to do? For the first 90 days, whatever is the lower value, that you tax it. However, after 90 days, both accommodations will be taxable. Both will be taxable. Rent-free accommodation is fully exempt for High Court and Supreme Court judge in the old regime, not in the new regime. Fine. So this is the rent-free accommodation. Now let's come to hotel facility. So hotel facility, very simple. The employer is sponsoring the hotel stay of the employee. In such case, taxable perquisite is equal to 24% of salary or rent paid by the employer, whichever is lower. So 24% of salary. So here what salary we have to take? The salary is the same as rent-free accommodation, that is ABB CDM, don't include AAPR. Okay, taxable allowance, then basic salary, bonus, commission, DA terms, monetary payments. Don't include advance salary, arrears of salary, retirement benefits and provident fund payment, etc. So that you have to remember. So this salary you have to take for what period? The period for which the employee is staying in the hotel. For that period you have to take multiplied by 24% or rent or charges paid by the employer, whichever is lower. It will be the perks value. In case of transfer of employee, perquisite is fully exempt if the hotel stay is up to 15 days. So if the employee is getting transferred 15 days varikum, there is no perquisite. Above 15 days only there is perquisite. Salary shall be taken for the period during which the employee is staying in the hotel. Now let's talk about loan for concessional interest. Concessional interest loan means what? The employer is giving a loan to the employee, and on that loan either the employer is not at all charging any interest or the employer is charging a very low interest. In such case, what to do? Whatever interest difference is there, no, it will be treated as perquisite. So how to calculate? Taxable perquisite is equal to loan value multiplied by SBI interest rate as on the first day of the previous year. SBI means what? State Bank of India. So State Bank of India interest rate minus actual interest rate. Okay, this calculation has to be done at the end of every month and all the amount should be added up. So every month end this calculation has to be done. That is loan value multiplied by SBI interest rate minus actual interest rate. Then add up all the monthly value, you will get the total value of perquisite. Okay, this loan can be given to the employee or any family member also. Now, there are two cases where no need to tax this interest perquisite. Case number 1, where the loan value is up to 20,000. Case number 2, the loan is given for specified disease like cancer or tuberculosis, etc. In these two cases alone, no need to tax the perquisite value. Now, let us talk about gift, voucher or token given by the employer to the employee. So, if gift is given in money form, it is fully taxable. If employer is giving gift in money, fully taxable. But if it is other than money, if it is given in kind, then up to 4,999 it is fully exempt. If it is 5,000 or more, it is fully taxable. Up to 4,999 exempt, 5,000 or more fully taxable. Now let's talk about specified security. Specified security means what? Sweat equity. Sweat equity means the company is giving its employees the company's own shares at a very concessional price. Let's say the market value of shares is 1,000 rupees, but they are giving only for 200 rupees. Market value 1,000 rupees, but they are giving only for 200 rupees. In such case, the balance 800 is there, no, which is market value minus exercise price. This 800 will be treated as perquisite. Okay, so it means shared offered at concessional rate. Taxable perquisite is equal to fair market value as on the date of exercise minus issue price. How to calculate this fair market value, sir? First, we have to see whether the shares are recognized in stock exchange or not recognized in stock exchange. If it is recognized in stock exchange, then you have to see as on the date of exercise whether it was traded or not. If it was traded, then fair market value is equal to opening balance plus closing balance divided by 2. Opening balance plus closing balance divided by 2. But if it was not traded on the stock exchange, then you have to see only the closing balance on the last date on which the trading previously took place in the highest volume stock exchange. Okay, so if during the date of exercise, if trading has taken place, which stock exchange you have to choose where there is highest volume? Go to that stock exchange, take opening price and closing price, do divide by 2. That is only the fair market value. If trading has not taken place, take the previous date on which trading took place, take the closing price alone. No need to take average. Then if buy price is given, sell price is also given in the question, then just take the sell price and solve the answer. Then what if the shares are not recognized in stock exchange? In such case, fair market value is the value that is determined by the merchant banker. Value determined by merchant banker on the exercise date. But sir, every day and all, it is not possible to get the value of merchant banker. That is why this merchant banker value can be up to 6 months old also. So if above is not available, then fair market value is the value determined by merchant banker, not being a date which is more than 180 days earlier than the exercise date. So up to 180 days old value is also acceptable if it is not recognized in stock exchange. Then now let's talk about employee of a startup. If the employee is employee of a startup, in such case, they can postpone the taxability of this sweat equity shares. How can they postpone? See here, if an employer is an eligible startup, then the above perquisite shall be taxable in the year after the expiry of 48 months from the end of relevant assessment year. So come to the end of the year, from there you calculate 48 months. So for previous year 25-26 up to 31/3/2031, no need to pay the tax on the perquisite. Then or the year in which the sale of such security or share is made by the assessee. Let's say before this 31/3/2021 itself, the employee has sold these sweat equity shares to some other person. Then in such year it will become taxable. And lastly, in the year in which the assessee ceases to be the employee of the employer. So let's say up to 2031 it is not taxable, I told you, no. But in 2027 itself the employee has quit the organization. Then in 2027 it will become taxable. So what did I say? 48 months or sale of share is made by the employee, or employee ceases to be the employee of the organization. In such case, whichever is earlier, it will become taxable. So what did we see? In case of eligible startup, the sweat equity amount is taxable. However, the taxability can be postponed to a future date. Then fair market value of shares will be there. No, they will become the cost of acquisition for the future capital gain purposes. So Kanna, listen here. Let's say employer is giving 1000 rupee fair market value shares, but exercise price is only 200 rupees. So how much is the employee paying to the employer? Only 200 rupees is being paid. So what will be the cost? The cost will be 200 rupees per share in the hands of employee. However, in the salary head of income, the employee is considering 1000 rupees as fair market value, and balance difference of 800 rupees he is paying the tax. He is paying the tax under salary head of income, correct? That is why, as per Income Tax Act, even though he has paid only 200, but since he has considered 1000 rupee fair market value to pay the tax, that is why 1000 rupees will become his cost of acquisition for future. The same concept I am also going to explain you in capital gain revision. There also we will see that if at all you are receiving some amount or some security, for that security you have considered some other value and paid the tax on that value, then that fair market value will become your cost. It will become your cost. So fair market value of shares will become the cost of acquisition of such shares for future purposes. So in future, whenever you are going to sell, no, at that time the cost will be taken as 1000. It will not be taken as 200. You know why? Because considering 1000, you have already paid the tax. So now onwards you can take your cost as 1000. I hope you are clear with the concept. Now let us talk about usage of movable assets. So use of laptop and computer. If the employer is providing laptop computer to employee, it is always exempt, never taxable. It is assumed by the Income Tax Act that laptop and computer is always for official purpose. That is, it is exempt. What about other movable assets, sir? Sir, listen. Laptop and computer, does it include mobile phone? Answer is no. It does not include mobile phone. So laptop computer is exempt, but mobile phone will be taxable. Fine. So other movable asset, you see whether the asset given to the employee, whether it is owned by the employer or rented by the employer. If it is owned by the employer, then 10% of the cost will be the value of perquisite. If it is rented by the employer, then the amount of rent paid by the employer will be taken as the value of perquisite. Now let us talk about transfer of movable asset. So first, what did we see? Usage of movable asset means what? Employer is only having the asset. He is just giving to the employee for usage. However, now we are seeing transfer of movable asset. It means what? The employee is getting the asset and the employee will become the new owner of the asset. Employer is giving the asset to employee that niye vechuko, it is your asset from now onwards. So that is only transfer of movable asset. In such case, how to calculate the value of perquisite? So value of asset you have to find out. Value of asset only will become the value of perquisite in the hands of employee. So how to find out value of perquisite? For that you have to find what is the depreciated value. Depreciated value minus amount recovered by the employee. Let's say the employer has given some asset to the employee for which he has paid some amount. So that amount also has to be reduced, no? Correct? So that net amount will become perquisite value. So how to find out depreciated value, sir? For that, if at all the asset is a computer or electronic item, for that you have to do 50% WDV method. Follow 50% WDV method. For motor car, it is 20% WDV method. For any other asset, it is 10% straight line method. So what did I say? Computer or electronic item 50% WDV method, motor car 20% WDV method, and any other asset 10% straight line method. You have to do the depreciation, and depreciation is not for financial year Kanna. Depreciation is for completed year of usage. So listen, for example, the asset was purchased on 29/3/2024. In such case, 1 year will be over on which date? 29/3/2025. Okay, 2 years will be over on 29/3/2026. Fine. So if the asset is sold, on 30 June 2025 to the employee, then how much year depreciation you have to minus? Only 1 year depreciation, because only 1 year is over. After 1 year it has been sold. Let's say the asset is being sold on 31/3/2026. In such case, how much depreciation you will take? You will take 2 years depreciation because 2 years are over, 1 and 2. That is why 2 years depreciation you will take, and then only you will compare it with the, you will take it as the value of perquisite. So like that, for completed year of usage, you have to calculate depreciation. So computer and electronic item 50% WDV method, motor car 20% WDV method, any other asset 10% straight line method. So here you have to be very careful. This depreciation and PGBP depreciation, there is no link. Okay, this is completely different. That is completely different. Now let us talk about all other perquisites. So all other perquisites will be taxable at fair market value. Fair market value, or whatever is the amount incurred by the employer will become the perquisite value of the employee. Now let's talk about deductions. Deductions are given under section 16. In section 16 there are 3 deduction karna. First is the standard deduction. Standard deduction is the only deduction which is allowed in old regime also, and it is allowed in new regime also. Moreover, in new regime extra benefit is given. In old regime 50,000 is the standard deduction. In new regime 75,000 is the standard deduction. So very rare case where new regime is giving extra benefit to the employee. So old regime 50,000, new regime 75,000. Now let's talk about entertainment allowance. Entertainment allowance is allowed as deduction only in case of old regime, not allowed in case of 115 BAC. So first what you have to do, whatever entertainment allowance is received, that you have to add it to the salary head of income. Then you can claim the deduction also. But you know who can claim deduction? Only government employee can claim deduction. Other than government employee cannot claim deduction for entertainment allowance. That also how much deduction, sir? The deduction shall be 1/5 of basic salary or entertainment allowance received, or 5,000 per annum, whichever is lower. Whichever is lower. Karna, it is not 5,000 per month, it is 5,000 per annum. So in the entire year itself, maximum deduction can be claimed as 5,000 only. So 1/5 of basic salary or entertainment allowance or 5,000, whichever is lower. So in computation of income, first add to salary, then claim the deduction if the employee is a government employee and taking the old regime. Now let's talk about professional tax. Professional tax is the tax on employment that is to be paid to the municipal authorities. This professional tax also, it can only be claimed as deduction in the old regime, not allowed in the default tax regime. Here what you have to do, if employer is paying the professional tax, then first add the professional tax to salary, then you can claim it as deduction. But if employee is paying the professional tax, then no need to add to the salary, directly you can claim it as deduction. And here there is no limit. Whatever amount is paid can be claimed as deduction. Now let's talk about section 89 relief. Section 89 relief is for arrears of salary. Now listen carefully, Kana. What is the concept? Let's say for the past 5 years, arrear salary has been received in the current year. Then what will happen? In current year, my income will go up like anything. Since my income goes up, I have to pay tax in the higher tax slab. That is 30% slab I have to pay the tax. But if this amount was received in that year itself, then I would have paid the tax in the lower tax slab. Correct? So if arrear amount is received in same year, it will be paid in lower tax slab. But since entire amount is received in current year, I will pay the tax in higher tax slab. That is why whatever is the difference of tax, how much ever extra tax that I am paying, that is allowed as relief. That is allowed as relief. So first you have to calculate the tax for current year and all the arrear assessment year, including arrear and excluding arrear. Then find out what is the arrear tax. So arrear tax means what? Tax including arrear minus tax excluding arrear. That is only arrear tax. So find out the arrear tax. Then what is the relief? Relief is equal to arrear tax in the current assessment year minus sum of arrear taxes of the relevant assessment years. So that is only arrear tax. This arrear tax you can reduce from the total tax, and balance amount only has to be paid by assessee. Now here you listen, one very important point. Generally whatever adjustment is made is made before health and education cess. For example, rebate calculation is before health and education cess, marginal relief is before health and education cess, surcharge is before health and education cess. So all these adjustments are before health and education cess. However, when it comes to relief, relief is calculated after calculating health and education cess. So in this arrear tax, you have to include health and education cess also and then solve the question. Fine. Now let us talk about the exemptions, Kana. First exemption is section 10 clause 6 subclause 2. Very important. Now all these exemptions that we are going to discuss now are all for non-resident, non-citizen. They are not citizen of India also, they are not resident in India also. Non-resident, non-citizen can claim these exemptions. So first exemption is for official of an embassy, high commission, legation, consulate or trade representative of a foreign state. So from foreign country, the government staff is coming here and working in India. For example, in Chennai, there is a US consulate. Correct? In US consulate, US citizens will be working here. So their salary will be exempt. Their salary will be exempt. But there is a condition. In a condition that when our people are working in USA, then our salary also should be exempt in USA. So remuneration of our corresponding government official in such foreign country should also be exempt. That is a condition. And second condition is that the employee should not be engaged in any business or profession or employment in India. So the employee should not be doing any other business. Let's see next section. Section 10 clause 6 subclause 6. Foreign national employee of a foreign enterprise. So if any foreign person is coming to India and working here, then generally their salary will be taxable, because if you work in India and earn the salary, that salary is taxable. However, this foreign national person, if they are coming to India and India they are doing some project and working over here, then their salary will be exempt, subject to condition. What is the condition? The foreign enterprise should not be doing any business or trade in India. So whatever company they are working for, no, they should not be doing any business in India. Then second, employee's stay should be maximum 90 days. So it should not be more than 90 days. And third condition, the remuneration is not liable to be deducted from the employer's income chargeable to tax. So employer should not claim deduction also. So employer should not be doing any business also. Employer should not claim deduction also. And employee should also stay for maximum 90 days. In such case, the salary received by the foreign employee will be exempt from tax. Then section 10 clause 6 subclause 8, non-citizen non-resident employee of foreign ship. So if non-citizen non-resident employee of a foreign ship is coming to India, if their stay is up to 90 days, then their salary is exempt. Then last one, section 10 clause 6 subclause 11, employees of a foreign government. So if foreign government employee is coming to India and doing the training in Indian government, then their salary will be exempt. So remuneration received from their respective government during their stay is fully exempt. Condition, the remuneration should be received in connection with their training in any undertaking owned by government or company wholly owned by central or state government, or any company which is subsidiary of the above, or statutory corporation, or any registered society which is wholly financed by central government, state government, etc. So it means what? In government organization, if the foreign government employee is coming here and doing the training, then their salary is going to be fully exempt. Swaha. So salary is such a huge chapter. One shot, we have done the entire revision. I hope that you are clear, and just listening to this lecture is not enough, Kana. I have done so much hard work to make this lecture so that it is as student friendly as possible. Now it is your responsibility to go through this once again and memorize all the parts so that you don't miss any marks in the examination. Kana, I wish you all the best of luck. See you in the next lecture, Kana. Till then, take care. Bye bye.